Hey everyone, it is Evan here from the Trade Risk on Tuesday, June 11th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So if we jump into our market technicals dashboard, we can see it was a quiet day here on Tuesday. Most of the indices just really treading water, closing slightly red to slightly green on the day, but otherwise flat. But they are holding on to some strong 5-day change numbers. We had pretty much a record year-to-date week to the upside last week, and we are holding on to those gains. In fact, we've added to them based on Monday's session. So that does keep us above most of the key shorter-term moving averages. The IWM and the Q is faltering a little bit around the 50 and the 200 SMA. Otherwise, things are technically getting repaired from the damage of May. Now, if we scroll down just a little bit here, we can see sector performance, technology, and semiconductors, followed by discretionary rounding out the top three. And on the downside, we have biotech, which is the only thing in the red over the past 5 days, followed by utilities and transports, which are still holding green. Major markets, S&P 500, China, and emerging markets, those are the top three risk assets. Equity markets as a whole just really leading the charge to the upside, and we have volatility, natural gas, and silver on the downside. So let's jump into the price action this week. Let's start it off with the weekly picture here of the S&P 500. We can see that so far we are up 0.42% at the close here on Tuesday. And if we look here at this week's candle, it's been fairly tight trading, but we have gotten a little bit of perhaps a rejection of these highs over 2,900. So on Monday's trading session, yesterday's trading session, we did try and poke our head above last week's highs. We tried to continue the momentum that we really saw surge last week. But so far that has been fairly muted. We've kind of got a rejection back down towards this week's lows. There's still plenty of trading left for this week, so it'll be interesting to see how this candle forms. But right now, some early signs of at least needing to take a bit of a break after the nearly 5% move that we saw last week in the S&P 500. So kind of like what we talked about in last week's video, what I really, from a bullish standpoint, what bulls really would like to see here is just the fact of holding on to the majority of last week's gains. That would be constructive to not just come back down and give back all of the progress that we made last week. So going forward and closing out this week, it's fine to pull back here, and in fact I think it's quite normal to sort of pull back here. And as we mentioned here, 2,800, that's still the nice round key psychological level that I would like to see this market continue to hold in the near future. So basically pulling back into it, basing out above 2,800, I think would be perfectly healthy and would potentially set us up for a nice constructive second leg higher back to tackle those all-time highs. Now, of course, the market doesn't have to do that. We can continue to just charge up here, and if we do continue to hold last week's highs, we hold above 2872, then we are not far whatsoever from tagging all prior all-time highs. We are about 1.5%, well, actually closer to 2% from all-time highs based on where we closed on Tuesday here, so not very far at all. But all in all, a big picture, weekly chart really showing 2,800, 2,872, 2,941. Those are the levels that I'm paying attention to for the market to challenge until and if one of those levels start to get taken out or addressed, particularly 2,800 or 2,942, then it's sort of a waiting game in here for the market to sort of make up its mind. Now, if we go down to the daily chart of the S&P 500, again, you can see just how vertical the move has been over the past 6 trading sessions. Today's session, of course, a little bit sloppy here, kind of indicative of some short-term exhaustion up here, especially the way Monday kind of finished off, and then Tuesday's session here. So once again, I wouldn't be surprised to see us kind of probe back down into this to the middle of last week's range, but looking at the pullback and judging how far we actually pull back, if we pull back, that's what's going to give us clues to see how real last week's trading, thrust off of those lows really is. So that is mostly the S&P 500. 2872, that's the next nearby level, and basically the highs here from the second week of May. If we want to look here at the VIX, we can see that this is holding pretty firm around this $16 area. So it's not really giving much back. It's not just rolling completely over and making new lows here. It is holding up and kind of a higher low from the second week of May. So it's a little interesting that the market still seems to be kind of hedged out perhaps a little bit, or just waiting on some of this news, maybe some of the macro tariff talk to simmer down or come to a more of a clearer resolution. But the VIX is kind of just hanging up here at 16. So potentially saying that there's still something that we want to see start to clear up or get some clarity behind before the market really feels comfortable to start trending back to those prior highs. So keep an eye on the VIX, and on the other kind of bear case, or the slight kind of seller, the thorn in the bull case, if you will, is still the Russell 2000. Really, again, not doing a tremendous amount wrong here. We are still off of the lows from last week. We did recover above 148, which was the March lows, but you can see here on the week it is up slightly lower, 0.29%. You can see on just a relative basis it's still kind of at the bottom end of this range here. So there is a little bit more of a hesitation behind the small caps right now, and if you combine that with perhaps maybe the VIX that's hanging out at 16, maybe have a little pause here. And again, given the 5% move that we saw in most equity markets last week, I think it's perfectly reasonable to see some type of pullback and digestion here, whether through time or price. But what we wouldn't want to see, and IWM is going to be a good spot to again pay attention to it, is just a complete give back of last week's gains. And if we are going to do that, it seems like the Russell 2000 might be the first to do that. So that's why we want to pay attention to this. Let's see if we can hold above this 148.50 area. If we start to lose that, then we got to be a little more cautious here in this in the small cap specifically, and chances are it sort of bleeds over or weighs onto the market as a whole. Now, last but not least, Qs here are still holding up pretty strong, adding nicely to the gains, up 1.3%. So we're getting immediate follow through to last week's gains. Again, you can see a little bit of a tail on the top end of this week's range so far, but all in all, this is a pretty constructive looking picture here. 5 weeks down, high volume reversal, taking out the prior day's highs, and then getting that immediate follow through on a weekly basis. We'll see how it finishes out the week, but the Qs here showing some signs of strength, even though it is only Tuesday. Last but not least, if we looked at some breadth readings here, we do have breadth that has recovered nicely as well, which also sort of adds to the bull case, and that's something that we'll need to just continue to monitor. But all in all, it does seem to be a more constructive picture here after last week's trading. We're holding on to those levels, so life is looking better and clearer for the bull case right now. Now, getting into some of the other major markets, we go to TLT, which is down here slightly on the week. Closed flat on Tuesday, but it was down on Monday. We finally exited our position here in TLT, the remainder of our position on Monday's gap down, so we no longer have a long trade in this anymore. Locked in the rest of the last of the third for nice profit here, but TLT just looks like it's in kind of back into consolidation mode. It's had a remarkable run over the past several weeks, months, and a little bit of digestion here seems totally reasonable. I don't think sellers really have the upper hand right now. It's mostly just kind of a sideways pullback, consolidation through time. Might take some more time, might get all the way back down to this 128 level. We'll have to see how this plays out, but for now, let's let this market reset and start paying attention for follow-up moves after that. Next, if we go to metals, GLD here did gap down on Monday and kind of held sideways here on Tuesday. Once again, this had a very strong last week session here, rallying off of this 121, really kind of thrusting away back to the year-to-date highs. We're pulling back here. I like GLD on pullbacks. I think based on what we saw last week with the volume coming in and the expansion and series of gap ups, I think there's some urgency there that gives it some credit here that a trend wants to sort of emerge to the upside. So I'd be watching this pullback, sort of interested buyer, but for now I'm just kind of waiting and just letting this play out, letting the dust settle just a little bit more before kind of jumping in or putting on any exposure there. Now, silver is arguably part of what's giving me the hesitation here is just silver losing that $14 area. I don't like to see silver kind of continuing to underperform, or just feels a bit heavy here. We're not as excited to rally on the upside, it seems, in silver as we are in GLD. So I'd like to see that change a little bit. I'd like to see us back over $14 to give us more confidence in sort of the metals trade. But silver pulling back, gap down yesterday, stabilizing today on Tuesday. We'll see if it can get itself back over that $14 area by the week's close. Last but not least, if we look at some energy here, we got USO, which is down slightly here on the week, or a little more modestly, minus 1%. Again, this had a nice move off of the lows. This still looks like in a real tough spot here. Technical damage to the downside is really kind of set in over the month of May. So momentum is still kind of favoring sellers. It is extended to the downside. It could easily be popping back up here for a move, even all the way up to $12. But for me, just really not that interested in it until it can stabilize a bit more. And natural gas shows a little signs of life here. Again, this is pretty much looking horrible on all time frames. And sometimes when it looks at its absolute worst, when everyone hates it, that is where that magical bid or the inability to continue to trend down reverses. And in this case, maybe that's what we're seeing here. Natural gas getting a pop today, 1.5%. Not a whole lot of volume coming behind the move here. So it'd be more interesting if we just saw some sharp reversal with some, very heavy volume. That would give us some more indication, maybe confidence in the short term that there's a tradable bottom here. But for now, the trend remains down on virtually all time frames. Even on the shortest time frame, or even on the daily here, I'd want to see this at least over 2160, reclaiming the old pivot here, the old low from April, to get even remotely excited about natural gas. So that is it. That is the rundown there on major markets and equity markets as a whole. As always, thank you so much for tuning in and watching every Tuesday and Friday. You can subscribe on YouTube, follow us at The Trade Risk, thetraderisk.com. Thanks so much, and we'll see you in the next video update.